Greetings, family. This is your brother in the kingdom, Emmanuel Destiny. Welcome to yet another valuable episode. And of course, today we're talking about different ways to trade Forex. And of course, this is episode number 5 in our Forex Beginners course or Forex Beginners series. Welcome to our channel, guys. Make sure that you get to subscribe, like, and share this video, of course, with your friends and family who might not know or might not have as much information when it comes to trading. Anyway, we're just gonna go and dive in straight into the content, into the information now, the different ways to trade Forex. That's what we want to talk about. And of course, Forex is so awesome in the sense that us as traders, we came up with different ways to invest and speculate in currencies. And among financial instruments, the most popular ones are retail Forex. Okay, where retail Forex we speak about you and I. Okay, spot FX currency markets, or rather currency futures, currency options, currency exchange traded funds. So you've heard this word ETFs. Some of you have signed up with brokers and just sign up and you didn't know exactly what you're signing up for. So I'm going to be teaching you that today. And of course, we're Forex FCD. Some of you know this. My channel is actually based on this, where I teach on how to trade some of the the CFDs rather. So where we have NASDAQ, we have all of those fall under CFDs. And of course, we have Forex spread betting. Okay, we're gonna talk about that. Some of you are trading volatility indexes. Those what we call Forex spot betting. And of course, it also shows us here on this diagram that of course we have different ways to trade currencies, in the sense of futures, we have options, we have EFTs, we have the spot FX, which is you and I, where we belong, we are under, of course, everything that's under the Forex, retail Forex, FCD, and spread bet. Okay, so now we want to go into those different ways. And the first way that I want to talk about it, or the first one, is currency futures. Okay, so when we talk about currency futures are contracts to buy and sell a certain asset at a specified price on a future date. That's why it's called future. And of course, future currency is a contract that details the price at which currencies could be bought or sold, and set, of course, a specific date for the currency. Because we have currency futures were created, of course, by the CME way back, of course, in the 1972, when bell bottoms and the platform boots were still in style. Okay. And of course, since futures contracts were standardized and traded on a centralized exchange, the market is very transparent and well regulated. This means that the price and the transaction information are readily available. Okay, so the first three that I'm going to be talking about, of course, centralized, and we're getting into retail trading where it's decentralized market, but it's important to know because these are also under the Forex market. Then we have the second one here, which is currency options. And when we speak about currency option, it's an option. So, basically an option is a financial instrument that gives the buyer the right or the option, but not the obligation to buy or sell an asset at a specified price on the option's expiration date. If a trader sold an option, then he or she would be obligated to buy or sell an asset at a specific price at the expiration date. Just like futures, options are also traded on an exchange such as the Chicago Exchange or the International Securities Exchange or the Philadelphia Stock Exchange. However, the disadvantage in trading FX options is that the market hours are limited for certain options and liquidity is not as nearly as great as futures or the stock, or rather the spot market. Okay, and of course we have currency EFTs. This is what I spoke about. So many of you have signed up on brokers and say, well, I've traded EFTs for the last 6 months. You haven't. Okay, so but of course they will ask you that to just test exactly how much you know of Forex. Now if you're watching this video, definitely you will know exactly when you're signing up on that broker contract. And of course I'm mentioning it so much because we're actually going to talk about it in a few minutes right now. But we have currency EFTs, and of course a currency EFT offers exposure to a single currency or basket of currencies. A currency EFT allows ordinary individuals to gain exposure to the Forex market through a fund, or rather a managed fund, without the burdens of placing individual trades. Okay, so now we are getting in and you're about to actually make sense of this. Now we're actually talking about brokers as we are going in deeper here. And of course, they can also be used to speculate on Forex, diversify a portfolio, hedge against currency risk. And here's, of course, the most popular traded currency EFTs. EFTs are created and, of course, managed by financial institutions that buy and hold the currencies in a fund. They then offer shares of the fund to the public on an exchange, on allowing you to buy and trade these shares just like stocks. Okay, so you've watched those movies like The Wolf of Wall Street. This is exactly what you are talking about, EFTs. This is exactly what they were actually doing. Like currency options, the limitation in trading EFTs is that the market isn't open 24 hours. So they're basically like 9 to 5. And of course, EFTs are subject to trading commissions and other costs as well. So that was the third one that I wanted to talk about. Now we have the fourth one, which now you and I fall under this market. We call it the spot FX. So the spot FX is an off-exchange market, also known as over-the-counter OTC market. The off-exchange Forex market is a large, growing, and liquid financial market that operates 24 hours a day. And of course, this is not a market like in the traditional sense where there's a central trading location or an exchange, just like your London Stock Exchange. We are a decentralized, meaning in an OTC market, a customer trades directly from the counterparty. That means you trade directly from your broker. Unlike currency futures, EFTs, and most currency options, which are traded through centralized market, the spot FX are over-the-counter contracts. Now you gotta focus and listen to me carefully now. The private agreements between the two parties. Okay, so most of this trading is conducted through electronical networks, or rather via the internet. Now, because I want to say something now, and I want to need your utmost focus. So the primary market for the FX is that the inter-dealer market, where the FX dealers trade with each other. A dealer is a financial intermediary that stands ready to buy or sell currencies at any given time for its clients. Now, the inter-dealer market is also known as the interbank market due to the dominance of banks as FX dealers. You get me? We're going somewhere, guys. The inter-dealer market is only accessible to institutions that trade in large quantities and have a very high net worth. As I've been saying, that the Forex market is actually interbank and the retail market. So the interbank is responsible for us when it comes to the spot market, or to this OTC, which is basically the Forex market. This includes banks, insurance companies, pension funds, large corporations, and other financial institutions manage the risk associated with fluctuations in currency rates. In the spot FX, an institutional trader is buying and selling an agreement or a contract to make or take a delivery of a currency. I will explain that right now. So a spot FX transaction is between two parties. An agreement to physically exchange one currency against another currency. This agreement is a contract. This means that the spot contract is binding obligation to buy and sell a certain amount of foreign currency at a certain price that is the spot exchange rate or the current exchange rate. For example, now, if you buy EURUSD on the spot market, you are trading the contract that specifies that you will receive a certain amount of euros in exchange for US dollars at an agreed price, okay, or an exchange rate. So basically what I'm saying is that we're not actually trading the underlying currencies ourselves, but the contract involving the underlying currencies. Even though it's called spot, the transactions aren't exactly settled on the spot. In reality, the FX spot trade is done at a certain current market rate, and the actual transactions is settled until 2 business days or the day after the trade. And this is known as T+2, today plus 2 days. This means that the delivery of what you buy and sell should be done within 2 working days and is referred to as the value date or the delivery date. For example, like as you trade on your MetaTrader, it will write the dates, and you'll notice that sometimes the dates are not actually the day that you executed, or the time is not actually the day when you closed or opened the trade, if you get me. For an example, an institution buys EURUSD in the spot FX market. The trade is open and closed on a Monday and has the value, or rather the value date, on Wednesday. This means that you'll receive euros on Wednesday. Not all currencies, of course, settle for +2 though. For example, USD CAD, USD Trader, USD RUB, USD Philadelphia or something like that. I think it's Philippines right there. And of course, we're value date that will be +1, meaning that one of the business days or the forward day, that's when you're actually going to get your delivery. And of course, this does not actually or rather it's not relevant to retail forex traders, because all of this work that I just mentioned is actually done by our brokers. Okay, so now we want to talk about retail forex, which is exactly where you and I get in here and fit in the market. Now, there is a secondary OTC market that provides a way for retail. Okay, so we're not as rich as other traders there. That's why you get when they're interviewing traders and they say it's an options trader whatsoever. They're very wealthy in the sense that they are established, and of course they have businesses and all of that. But when you talk to retail traders, it kind of sounds a bit dodgy in the sense that when you try to find out their net worth. Okay, but that's another topic for another day. Retail, of course, these traders participate in the forex market. Access is granted by so-called forex trading providers. These are what we call UNI forex trading brokers. Forex trading providers trade in primarily the OTC market on your behalf. So they basically find the best available prices, then they mark it up before displaying the prices on their trading platforms. So for example, if you go into a store, and of course the store itself buy their stuff from a wholesale market, and of course they add markups and show the retail price to their customers. So they show you how much they actually want to sell it to you. That's the retail price, the price that they're actually giving to you for them to make a profit. Okay, so that's exactly that happens in our brokers. They take prices from the actual market and they add a little bit so that they can actually make a profit. We'll talk about spread. That's the adding that they do there. Okay, although the spot forex market contract normally requires delivery of currency within 2 days, in practice nobody takes delivery of any currency in forex trading. The position is called a roll forward on the day on the delivery day, especially in the retail market. Remember that you're actually trading a contract to deliver the underlying currency rather than the currency itself. So basically what I was saying earlier is that in the retail, we are not actually trading its actual currency as we see it. We're actually trading the contract that binds you and the broker to deliver the currency or the price fluctuations to you. And provided that when you trade and price moves in your direction, you will make a profit. That's when they will actually pay you. Okay, so we're actually trading that contract instead of the currency itself. This is not just a contract, it's a leverage contract. So retail forex traders can't take or make a delivery on leverage spot forex contracts. Okay, so now leverage allows you to control a large amount of currency for a very small amount. And guys, I am aware it's crossing 10 minutes, but this is a lot of information that you have to binge on, sit and write notes and understand it, even because it's really going to help you, even though it's not money-making information, but it opens your eyes, especially when we talk about the money-making concepts, guys. Okay, so retail forex brokers let you trade leverage, which is why you can open positions at 50 times the amount of the initial required margin. So like for example, with $2 or $2,000, you can actually open a EURUSD trade valued at 100,000. Imagine if you went short. So short means sell, guys. Okay, and you sold and you had to actually deliver 100,000 worth of euros. That's what you actually your broker does on your behalf. So they have to actually submit contracts, or they have to roll over, okay, for the client positions each and every time on their site. So retail forex transactions are closed out by entering in the equal. So because they don't have that 100K, let's say, to pay the interbank market, okay, for the transactions, they enter a trade opposite. So like for example, if you lose the trade, they've actually made profit from that trade. If you win that trade, they've made a loss from that trade. Okay, so that's how it actually works in here. That's the contract. So now we want to talk about as well, for example, that if you bought the British pound or the US dollar, like the GDP US dollar, and you close out by selling the GDP USD, this is called offsetting or liquidating the transaction. So this is, of course, is done on the broker side, what I'm talking about, guys. So if you have left the position at the close of the day, it will automatically roll over to the next day to avoid the delivery of currencies. Your retail forex broker will automatically keep on rolling your spot contract for you indefinitely until it's closed. Now we want to talk about why they will charge you those swap fees. So the procedure of rolling a currency pair is known as tomorrow next or Tom next, which means for tomorrow and the next day. When positions are rolled over, the result is either the interest is being paid or earned by the trader, and these charges are known as to many of us as a swap fee or a rollover fee. Your broker, and of course, calculates this fee for you, and you either debit it or credit it from your account balance, but mostly from the trade that you actually get to close. And you will see that they will show you like $1. It depends on how long you actually. That's why most traders don't actually prefer trading or holding trades. We prefer intraday trading. Okay, retail forex trading is considered speculative. That means traders are trying to speculate and make bets on and from, or rather profit from that, from the movement of exchange rates. They are not looking to take physical position of the currencies they buy or deliver the currencies they sell. Okay, because we're actually trading contracts. Okay, now on that note, we want to talk about forex bet, or rather forex spread betting. And so many people, you will see the word derive there. there's a broker called Believe where they actually allow you. So I didn't understand until I came across, and I felt it befitting to actually put this, especially for my South African brothers and sisters who are jumping onto MetaTrader 5 and they don't know exactly what they're trading. So we have spread betting is a derivative. It's a derivative product, which means that you don't take ownership of the underlying asset, but speculate whichever direction you think the price will go or go down, will go up or go down. The Forex spread betting enables you to speculate on the future price direction of a currency pair, okay? And a currency pair's price is being used on the spread bet is derived from the price pairs on the spot FX market. Your profit or loss is now dictated by how far the market moves in your favor, whether you close the position, and how much money you've made per point of the price, so amount of pips. But of course, we don't want to say pips now. Total beginners are going to be a little bit confused. The spread betting on Forex is provided by spread betting providers, and of course, in some countries, it's illegal to actually have this kind of stuff because it's considered as what, gambling. So like most of the other brokers like IQ option and of course Derive is not allowed in some countries because there is no actual reason why that is moving. It's called spread betting. Okay, now you know. And of course, a contract. Now, what we want to talk about now is CFDs. Many of you guys, you trade CFDs and you don't know exactly. Some of you have just taken on brokers to say, well, I've traded CFDs for the last 3 years. You are lying. But now let's teach you exactly what we are talking about here. Forex CFDs, a contract for the difference. That's what it stands for. Contract for difference is the financial derivative there. The derivative products track the market price of an underlying asset so that traders can speculate whether the price will rise or fall. The price of a CFD is derived from an underlying price share, or rather asset price. A CFD is a contract typically between the provider and the trader where the party agrees to pay the difference in value of the security between the opening and closing of the trade. Okay, now you get it, what you're actually trading. Most of the stuff that we're trading, we're actually trading contracts that are packaged as currencies or rather CFDs, as we're saying. In other words, a CFD is basically a bet on a particular asset going up or going down in value. With the CFD provider, you agree whoever wins the bet will pay the other difference between the price asset and when you enter the trade and its price when you exit the trade. The Forex CFD agreement or contract is to exchange the difference in the price of a currency pair from when you open the position versus when you close it. And the currency pair FCD's price is derived from the currency's price on the spot FX, or at least you should be. If not, what is an FCD provide based on price? So when we're talking about Forex trading FCDs, it actually gives you the opportunity to trade both currencies in both directions. You can take a long, you can take a short. And of course, the price moves within your chosen direction, you can actually make a profit. If it moves against you, you make a loss. In the UE and the UK when it comes to brokers, they decided that the rolling spot FX contracts are different from the traditional FX contracts. Of course, the main reason being is that rolling spot FX contracts, there is no intention to take actual physical delivery or ownership of the currency. Its purpose is to simply speculate the underlying price. I'm sure this is a lot of information to digest, but we are actually done now. This is the last slide, but I want you to keep on writing this notes, being diligent, because it's going to take you to the next level. So here, basically the objective of trading a rolling spot FX is to gain exposure to price fluctuations related to the underlying currency pair without actually owning it. So to make the difference clear, a rolling spot contract is ruled as an FCD, okay? And of course, some of the FCDs are known as retail Forex transaction. Of course, Forex FCDs is provided, or CFDs rather, is provided by CFD brokers, okay, or providers outside the US. Retail Forex trading is usually done in CFDs or spread bettings. In most brokers, that's what they do. Anyway, guys, I just hope that this has blessed you. I know it's so much information to consume at the very same time. I know little people actually watch this because we feel like, it's not really cool to go through a lot of theory like that and to just know it and to go. But I'm telling you, if I had not jumped the basics, you will have to go back to it. If you jump crawling, if you jump walking, you cannot start running. So many people want to start running before crawling. So we're going back to our foundation phase as traders and knowing very well that you and I know the basics, because as I'm teaching you, I'm also learning. You and I know the basics so that we do not forget the stuff as we're going into advanced trading. But I hope this information has blessed you guys. Please kindly subscribe, like this video if you're blessed by it. Thank you so much for tuning in. God bless you. See you at the next episode.